Hello traders, and welcome back to TradeShade, where you learn trading from the ground up. In this video we will learn about the participants in the financial market. Who is a buyer and a seller? What makes price move up or down? Moving to the first topic. Who are the participants in the financial market? There are a total number of 8 participants in the financial market. They are retail investors, traders, companies or corporations, banks and financial institutions, governments, institutional investors, brokers and stock exchanges, and last but not the least, the regulators. Individuals, retail investors, are people who invest their savings in stocks, bonds, mutual funds, or other assets to grow their wealth. Traders are individuals or firms that buy and sell financial assets frequently to make profits from price movements. Companies, corporations, are businesses that raise money by issuing shares, stocks, or bonds to fund their operations and expansion. Banks and financial institutions are commercial banks, investment banks, insurance companies, and mutual funds that provide financial services and invest money. Governments borrow funds by issuing government bonds and also regulate financial markets. Institutional investors are large organizations such as pension funds, hedge funds, and mutual funds that invest huge amounts of money. Brokers and stock exchanges. Brokers act as intermediaries between buyers and sellers, while stock exchanges provide a platform for trading. Regulators. Authorities that ensure fair and transparent markets are known as regulators. A simple way to remember this is to remember it through an ascending chart of power which is displayed on your screen. Savers, investors, companies, governments, financial institutions, markets and regulators. Now, let us move on to the next topic of the video. That is, who is a buyer or a seller? In a financial market, every trade has 2 parties, a buyer and a seller. A buyer is a person or an institution that wants to purchase a financial asset, such as stocks, bonds, currencies, or commodities, because they believe its value will increase or because they need it. Buyers create demand in the market. A seller is a person or an institution that owns or has access to a financial asset and wants to sell it, either to make a profit, reduce risk, or because they expect its value to fall. Sellers create supply in the market. Let's imagine a company's share is trading at $10. Jack believes the price will rise to $12, so he buys 10 shares of that company. Bridge already owns those shares and thinks $10 is a good price to sell, so he sells his 10 shares. The trade happens only because Jack is willing to buy the shares at $10 and Bridge is willing to sell them at $10. Key point to remember in trading is, every completed trade always has one buyer and one seller. Without both agreeing on a price, no trade can take place. Now, let us move on to the final and the most important topic of the video. What makes the price move? The price in a financial market moves because of supply and demand. When there are more buyers than sellers, the demand will be higher for the stock or the commodity, so buyers compete by offering higher prices. As a result, the price goes up. When there are more sellers than buyers, and the supply is high, which means the sellers are strong and compete by accepting lower prices. As a result, the price goes down. Let's understand this with an example. Imagine a stock is trading at £100. 1,000 people want to buy it, but only 500 people want to sell it. Buyers start offering £101, £102, and higher to attract sellers, so the price rises. Later, bad news is released. Now many investors want to sell, but few want to buy. Sellers lower their asking price to £99, £98, and so on until buyers are willing to purchase. Hence the price falls. If we say it in a sentence, price moves because buyers and sellers continuously agree on new prices, and whichever side is stronger. In short, buyers or sellers pushes the market up or down. Now, let us learn. What changes the supply or demand in the market? Major factors that changes the demand and supply in the market are as follows. News and events, company earnings, economic data, interest rate decisions, wars, or political events. Market sentiment. Fear makes people sell, while optimism makes people buy. Demand and supply. More buying pushes prices up, more selling pushes prices down. Large institutions like banks, hedge funds, and other big investors can move prices by placing very large orders. Economic conditions like inflation, unemployment, and GDP growth affect investor decisions. Technical trading. Many traders buy or sell based on chart patterns, support and resistance, or indicators, which can reinforce price movements. That's it for today's video. We covered who are the participants in the financial market, who are buyers and sellers, and why the market moves. Always remember, a trader is only as strong as the foundation he builds. In the next video, we will learn what is a trading account, who is a broker, and what is a trading platform. Until then, don't forget to like, share, and subscribe TradeShade.